What if I told you the bank doesn't really need your money to make money? It sounds strange, right? You work hard, earn your income, and deposit it into a bank. You think your money is just sitting there safely, waiting for you whenever you need it. Maybe you even feel good knowing you're earning a little interest on it. But here's the truth. Most people never realize. The moment your money enters the bank, it stops being just yours. It becomes part of a much bigger system. A system designed not to store money, but to multiply it, and this is where things get interesting. Banks take your deposits and use them in ways you probably never think about. They lend it out. They invest it. They charge fees around it. And in many cases, they even create new money based on it. Yes, create money. Not print it like a government, but expand it through a system that allows them to lend more than they actually hold. So while you're earning maybe 2% on your savings, your bank could be earning 10%, 15%, or even more using that same money. And they're doing this at an enormous scale. Millions of customers, billions in deposits, trillions moving through the system. Which raises a powerful question. If banks are making so much money using your money, why are you earning so little? And more importantly, what exactly are they doing behind the scenes that makes banking one of the most profitable industries in the world? Because once you understand this, something shifts. You stop seeing banks as a safe place to store cash, and you start seeing them for what they really are. One of the most sophisticated money-making machines ever created. Most people grow up believing a very simple story about banks. You deposit money. The bank keeps it safe. In return, they give you a little interest. That's it. It feels straightforward, almost harmless. But this belief hides a much bigger reality. Because if banks were only making money by storing your cash and paying you interest, they wouldn't be some of the most profitable businesses in the world. Here's where the misunderstanding begins. People think banks are like secure lockers, a place where money just sits. But in reality, banks are not passive at all. They are active, profit-driven institutions. Every dollar that flows through a bank is part of a system designed to generate more dollars. And this misunderstanding creates a dangerous blind spot. Most people use banks without ever questioning how they work. They open accounts. They deposit money. They take loans. They swipe their cards daily, but they never stop to ask, who is really benefiting from all of this? Because every time you use a financial service, there is a cost somewhere. It might be obvious, like loan interest, or hidden, like transaction fees, overdraft charges, or penalties buried in fine print. Individually, these costs seem small, but over time, they add up. A few dollars here, a percentage there, a missed payment fee, a credit card interest charge. Before you know it, a significant portion of your money is flowing right back to the bank. And here's the deeper issue. Most people think banks take risks, just like they do. But that's not entirely true. Banks are extremely skilled at managing risk. They structure loans carefully, diversify where money goes, and protect themselves with systems and regulations. So while individuals often struggle with financial uncertainty, banks operate with calculated precision. They make money whether the economy is booming or slowing down. And that creates an imbalance, because if you don't understand how banks make money, you end up playing a game where the rules are hidden from you. You become a participant, but not a winner. And that's exactly why this misunderstanding matters. Not just to understand banks, but to understand where your money is really going. So let's break this down in the simplest way possible. Banks make money through a few core mechanisms. Once you understand these, everything starts to make sense. The first and most important one is interest. This is the backbone of banking. When you deposit money in a bank, they pay you a small interest, let's say around 2% per year. It feels like your money is growing. Slowly, but safely. But the bank doesn't just hold that money. They lend it out to other people at a much higher interest rate. This could be 8% for a personal loan, 12% for a credit card, or even higher, depending on the risk. The difference between what they earn and what they pay you is called the interest spread. And that spread is where a large portion of bank profits comes from. Now, comes the part most people don't know about fractional reserve banking. Banks are not required to keep all your deposited money sitting in their vaults. Instead, they only keep a small percentage as reserves. For example, if you deposit $1,000 and the reserve requirement is 10%, the bank only needs to keep $100. The remaining $900 can be loaned out, but here's where it gets powerful. When that $900 is spent and eventually deposited into another bank, that bank can again keep a fraction and lend out the rest. This cycle continues, effectively multiplying the amount of money in the system. So, from an initial deposit, banks can expand the total money supply far beyond the original amount. That's how money is created within the banking system. Then there are fees. Banks charge for a wide range of services: ATM withdrawals, account maintenance, overdrafts, late payments, international transfers. Each fee may seem small on its own, but when millions of customers are paying them regularly, it becomes a massive source of revenue. Finally, banks also invest. They use their capital to invest in bonds, stocks, and other financial instruments. Some banks even engage in trading, making profits from market movements. So when you combine all these streams, interest spreads, money multiplication, fees, and investments, you start to see the full picture. Banks are not just holding money, they are constantly moving it, growing it, and earning from it. Let's take a step behind the glass doors of a bank and see what really happens with your money. Most people think banks are just buildings full of tellers and vaults. But the reality is far more complex and much more fascinating. Banks are carefully organized machines designed to move, multiply, and protect money at every level. First, let's follow a simple deposit. You walk in, deposit $1,000, and maybe feel good knowing it's safe. That money doesn't just sit in a vault labeled Sadaya's savings. Instead, the bank immediately records it in their system and combines it with millions of other deposits. From there, it enters a web of transactions. The bank keeps only a fraction called the reserve requirement safely in the vault or at the central bank. The rest becomes available for lending. That's how a single deposit can effectively fuel dozens of loans across multiple accounts, creating new money along the way. Next, the bank decides who gets loans and at what interest rate. This isn't random. Banks use sophisticated algorithms and risk models to determine creditworthiness. A mortgage applicant with a steady income and good credit might get a low interest rate, while a small business seeking a high-risk loan pays more. Every interest rate is carefully calculated to cover the risk of default and to ensure the bank still profits. In other words, banks are constantly balancing opportunity with caution, making calculated bets on who can pay back money. Then there's the part most people never see: investment banking and trading. Many large banks operate entire departments dedicated to managing assets, raising capital, and trading financial instruments. This could mean helping a company issue bonds, investing in stock markets, or even hedging against financial risks. These activities are separate from the deposits you put in, yet they rely on the same principles: leverage, risk management, and multiplying money effectively. A single well-timed trade or capital deal can earn the bank millions, sometimes billions, in just a few days. Banks also manage risk constantly. They don't just lend recklessly. They diversify loans across individuals, businesses, and government entities. They maintain reserves for emergencies. They buy insurance, hedge with financial instruments, and follow strict regulations. This is why, even during recessions or financial crises, large banks often survive where smaller businesses or individuals fail. Their system is designed to protect them first, and profit is a natural outcome of that protection. Finally, banks make money from the little things we barely notice: every transaction, service, and fee, ATM withdrawals, credit card payments, international transfers, overdrafts adds up. Individually, it seems minor, but multiplied across millions of customers, it becomes another major revenue stream. Combined with lending and investments, This creates a full ecosystem where money constantly moves, grows, and generates profit by the end of the day. Your money isn't just stored. It's active. It's part of a vast, highly orchestrated system that turns deposits into loans, loans into interest, and interest into profits while keeping the bank safe and thriving. Understanding this gives you an insider's perspective and shows why banks are far more than a safe place for cash. They are the engines of modern finance. Bring all of this into the real world. Consider one of the largest and most powerful banks on the planet, JP Chase. This isn't just a bank where people store money. It's a financial giant that generates tens of billions of dollars in profit every single year. So how does it actually do that? A huge portion of its income comes from interest. JPMorgan Chase lends money to millions of people through mortgages, personal loans, and credit cards. It also lends to businesses, corporations, and even governments. Each of these loans generates interest every month. Now, imagine this at scale. Millions of customers making payments, businesses repaying loans, credit card users paying high interest rates. All of that creates a steady, predictable stream of income. Then come the fees. Every time someone uses a credit card, there is a transaction fee involved. Businesses pay for processing payments. Customers pay late fees, overdraft charges, and account service fees. Individually, these might seem insignificant. But when millions of transactions happen every day, those small fees turn into billions of dollars. And that's not all. JPMorgan Chase is also deeply involved in investment banking. It helps companies raise money by issuing stocks and bonds. It manages assets for wealthy individuals and institutions. It even trades in financial markets, making profits from price movements. These activities bring in another massive stream of revenue. But here's the most important insight. A large portion of the money being used in all these activities does not belong to the bank. It comes from deposits made by customers, people like you. So, while customers earn a small percentage on their savings, the bank uses that same pool of money to generate much higher returns across multiple channels. This is leverage at an enormous scale. And this is why banks like JP Chase continue to grow more powerful year after year. They are not just holding money, they are turning it into a system that continuously produces more money. If you want to understand how money actually works, not the version taught in school, but the real system used by banks and the wealthy, this is your chance to level up. Subscribe to the Geeky Investor. Here, we break down complex financial concepts into simple, actionable ideas you can use in real life. Understanding how banks make money isn't just interesting, it's powerful. It changes the way you save, spend, and invest. Once you see the system, you can start making decisions that put you on the winning side, instead of always feeding the bank's profits. So hit that subscribe button, turn on notifications, and join us. Let's learn how money really works and start thinking like the system itself.